So welcome everybody to this personal tax event. It is a traditional fixture in the BCC calendar of events. Over the past few years, we have had the pleasure to organise these events in collaboration and cooperation with AMCHAM, and it's going very well. So I'm delighted to welcome you today to the 2021 personal tax event with our guest speaker, Laura Fools. Laura's been presenting and speaking in the BCC personal tax events for quite a few years now. And I mean, I think we're pretty much all very impatient to know what's in it for each of us. A summary of the important changes which have happened this year, any important personal tax announcements for next year, and if there's any way each of us can optimize our tax situation before the end of this year to be reflected in our tax returns, which we will be filing next year. Before moving on and before passing over to Laura, I shall kindly ask all of you here in the Zoom call, please do take into account that this event is being recorded. Please mute yourselves, please turn off your videos. And if you have any questions during Laura's presentation, please use the chat function, which you can find in the Zoom menu. And I'll be glad to take over your questions during a short Q&A session after Laura's presentation, so maximum 10 minutes of Q&A. We'll wrap up the whole event by 1 o'clock, and immediately after the Q&A, I shall pass over to Paul Schoenenberg, the president of AMCHAM, who will, I'm sure, have some words of thanks to all of you. So without further ado, I pass over to Laura to present this year's personal tax event. For lack of an actual lunch, I'm sure this will happen next year. Yeah. Over to you, Laura. Thank you.
Yeah, I think I did my slides in hoping that we would have some food as well, but everyone can feel free to eat a sandwich whilst I speak. It's not a problem.
Next year.
Next year. So yes, you're happy for me to start, or are there still people joining?
No, please do go ahead, Laura, that's fine.
Okay, all right, perfect. Okay, so yes, today we are going to cover some Luxembourg tax basics. We're going to look, as Jonathan said, at some things that have changed. I always try and cover one particular topic in a little bit more detail, just to give people a good idea of what's going on. I was thinking of maybe cryptocurrency or expenses this year, but non-resident payroll is proving particularly problematic. So I'm going to cover that in a little bit more detail. And then we'll finish with just a couple of the UK and US updates, which we always like to do since it's AMCHAM and the BCC who are supporting. So I will start with the tax basics. Now, for those of you who attended last year, this will be a bit of a refresher, but there's so many new attendees this year that it's really important to cover the basics. So this is what we start with. So when you're looking at Luxembourg tax, one of the key points that we start with is determining residency. Okay, Luxembourg being such a small country with so many people coming in the country every day to work, the residency situation is particularly important. If you are a Luxembourg resident, you must report your worldwide income. Even if it's taxed in another country, even if it doesn't come from Luxembourg, you must report your global income on your tax return. Very important. Non-residents have a different situation. Non-residents are taxed on Luxembourg income only, although where the bulk of their income is coming from Luxembourg, they can elect to be treated as a resident because then they can take certain tax deductions, and we'll come on to it a little bit more. Part-year residents, those are obviously people who come into or out of Luxembourg during the tax year. And they have other elections, other choices. They're potentially taxed only for the resident period, or in some cases it makes it's optimal to make an election to be considered a resident for the full year because you actually can claim a refund of tax. So some of these elections and, what is the optimal tax position? This is a little bit of the magic that we do as a tax advisor in the background when we're looking at these cases, because it's not always straightforward or intuitive what the best option will be. Okay, so residency is really key. The other point that's really key for Luxembourg is joint taxation. Now, not all countries have a joint taxation. Luxembourg does. So for married resident taxpayers, the default tax position is that you will file your tax return jointly with your spouse. For non-resident married taxpayers or people who have a PAX, it's the complete opposite. The default position is that you will do a separate filing. Okay. Now, since the start of 2018, there have been options to move away from the default position. Okay, so it is possible for married resident taxpayers to choose to file individually, separately from their spouse, but you have to make the election in a timely manner. And if you don't, you will go back to the default joint filing position. Okay. Taxpayers who are non-resident, again, they can elect for a joint taxation. And as I mentioned before, they can elect to be treated as if they are a resident. There are conditions to be met, okay? They have to have a certain amount of income from Luxembourg, and whether the elections are beneficial or not really depends on a case-by-case basis. Okay, we do have situations, with the non-residents where you've got one spouse working in Luxembourg, the other one is non-working. In a lot of cases, a joint taxation will be beneficial. In other situations, the spouse is working and has a high income, it's not going to be interesting to file jointly because you have to then declare the global income of both spouses. So it really does require analysis, and the optimal position for one year is not always the same as another year. So it's a forever moving situation, actually. The one point that is specific to partners who have the PAX is they can elect year on year. So there's no advance election, there's no election via a tax card for a change in position. They are treated as single all year long, and it's only on the very final tax return that they check a box and they can choose a joint taxation. So for all of these situations, a move away from the default is possible. There are conditions to be met for every scenario. And you need to normally take some advice to work out what is actually the best position for you. For the married resident, the default joint position, certainly for Luxembourg residents, is normally still the best outcome on paper. So we don't see too many people moving away from it, actually. The times when they tend to move away is normally if they're getting divorced or separated and they really don't want to file together. That's the most common time when we see that happening. The next thing to understand is tax class, okay? In Luxembourg, you have different tax classes depending on your situation. So the basic tax class is tax class 1. Okay, this applies to single taxpayers, and if you make an election to file separately, this would be your tax class. For single parents, you can have class 1A. And for when you are married, you are entitled to tax class 2. What's important to understand is tax class 2 applies to the joint income. So it's actually just 2 sets of tax class 1 in practice. But tax class 2 is really beneficial when you have one working, one non-working spouse. The working spouse is getting a much better tax position compared to if they were under tax class 1. For people who have the PAX, they are tax class 1 all year long, both partners. And again, like I mentioned, when you check that box on the tax return, they get class 2 against the joint income. But there's no advance possibility to claim class 2 if you have PAX, not a marriage. What the married taxpayers have to be very careful of and we see this catch a lot of people out, is that under tax class 2, you have a primary and a secondary tax card. So if both spouses are working, the first working spouse, normally the husband, will have the primary tax card, and this shows tax class 2. The second spouse, the tax card shows 15% flat rate. And in the majority of cases, this 15% withholding tax on the second salary is not enough. So for married couples who are both working, it's quite common for them to owe tax at the end of the year because of this 15% rate on the second tax card. If I go back half a step to the filing options, if you elect for one of the individual or assimilation filing options that are available for married couples, you can get a change in the tax card. It doesn't change the final tax, but it is possible that, again, we just don't see it in practice very often, okay? But it's, you know, a lot of people who are married to working spouses owe at the end of the year, and it can come for a bit of a shock, especially if you're new to Luxembourg and aren't aware of that situation. So once you've determined your residency, your tax class, whether you're going to make any elections or not, the next thing you have to do is to work out what form you need to complete. Now, there's actually 2 forms in Luxembourg. You have the Form 100, which is the tax return. This is the normal tax return. And this form is filed with one of the many tax offices in Luxembourg. In certain situations, you will file a simplified return, okay? And the simplified return is filled with the RTS offices, and you can only claim a refund on a simplified return. You can never owe additional tax. So with the Form 100, to work out whether you have to file a tax return or not, there are multiple conditions, okay? If you have elected for one of the non-default filing positions, you're going to have to file the Form 100, okay? If your income exceeds certain limits or thresholds, and there's different limits for different types of income, you will have to file a Form 100, okay? So the main ones that catch people are a single person with more than 100,000 of income. They're going to have to file a tax return. If you are self-employed, you are going to have to file a tax return in most cases because you haven't paid any tax all year. If you are both working, both spouses, you have to file when your income jointly exceeds 36,000. So it's a lot lower, and it's because of this second 15% tax card, you will have to file. The other one that catches people and comes back to the very first point where residents must declare global income. If you have more than 600 euros of foreign income, you have to file a Form 100. Okay, so that could be interest, dividends, rental income. You have to file a Form 100. So these ones on this page, these are the main ones that we see catching people. If you don't meet one of these conditions, you can file the 163 to claim a refund. Okay. On the 163, sometimes you have to declare only your Luxembourg income. Sometimes you have to declare your global income, and it depends on how long you've been working in Luxembourg and what percentage of your annual income comes from Luxembourg. The 163 is commonly used for non-resident taxpayers who have something called a non-continuous occupation. So this could be that they work from home Monday to Thursday, or they work from Luxembourg Monday to Thursday and work from home on a Friday. Their occupation in Luxembourg has a regular non-continuous pattern, and that would mean that they would file a 163 and not necessarily a 100. So it's quite complicated actually, just to work out which form you fill in. I'm going to focus now with the Form 100 because this is the big tax return. And this is the main one that we see people filing. Can I, just before I move on to the next slide, just remind anyone who's joining a little bit late just to mute because you get some feedback. Thank you. So with the main tax return, there are 8 categories of income, okay? You have to report your income per category, and there are specific expenses per category that you can claim as a deduction, okay? So for example, if you are an independent worker, you would be obviously taxing your income, and you would be claiming deductions for specific expenses, you know, in obtaining your independent income. If you have a rental income, you're going to claim rental expenses like repairs and maintenance against the rental income. If your income doesn't fall into a category, then it's not subject to tax. One of the main ones is things like lottery winnings. It's not subject to taxation. Investment income generally covers interest and dividends. Capital gains are actually captured in other. So that's where you would report income from capital gains. We're seeing a lot of people nowadays have some cryptocurrency. Cryptocurrency is largely taxed as a capital gain if you're buying and selling, so it would fall in the other category. Although people who have almost like a professional activity in cryptocurrency, if you're mining, for example, it can be considered as a commercial income, you know, the income from the cryptocurrency work that you are doing essentially. So you split your income into each category, you claim expenses per category, and this will give you a net income per category that will be subject to taxation. You then add all this income together, which is going to give you like a taxable base, and then you will take some standard deductions and credits that are kind of available to all, not related to a specific category of income. So in terms of common deductions, this slide shows the main categories that you are seeing people claiming on the tax return. What's important to understand in Luxembourg is that there is a concept of a household, okay? So a single person will be a household of 1. If you're married with 2 children, you will be a household of 4. And the limits to what you can deduct apply per member of your household. So for example, if you look here at the insurances, okay, you can claim 672 euros per member of your household.
Bonjour.
Okay, so a household of 4 will get a much bigger deduction under the insurances category. So if you own your home, then you're living in your home, you can claim mortgage interest. Insurances cover things like life, death, disability, a portion of home and car insurance can be deducted. Debit interest is obviously interest on private loans, not a mortgage, which would cover car loan, student loan, things like that. And these are the typical things we see in practice. Personal pension, if you take a Luxembourg personal pension, you can claim 3,200 per year as a tax deduction, and just remember that one because I'm going to come on to that again in a minute. The home savings scheme is quite popular. This, you can put some money into a savings account, the interest accrues tax-free, and then at the end of 10 years, you take the money out and you use it for your main home, so potentially a renovation or to pay off a mortgage or something like that. There's been a recent circular that's going to allow people to use it to install photovoltaic panels and some of the sort of eco renovations to properties. So there's certain things that you can use this money for, but it is designed for your main home. You can't use it to go and travel the world. The childcare and housekeeping, this deduction is one of the biggest on the tax return at 450 euros per month. It was increased slightly in 2020 during COVID, so you could deduct more in 2020 when you had a cleaner, but it's, you know, the standard one is 450 within the law. It's childcare and or cleaner. If you have children who do not live in your household, so this is common with divorced couples, one couple will claim, or one half of the couple will claim the children as their dependents, and they will get the deductions for insurances and interest, etc. The second parent who the children are not registered with will claim for supporting children who are not in their household. And here you have to provide some receipts and proof of how much you've paid in support, and you can claim about £4,000 per child. The eco-transport is very popular, and during COVID, obviously we saw a lot of people buying bicycles, so it's very popular at the moment. You can only claim this deduction on the tax return if you did not claim the state subsidy. We've seen many people try to double claim, which would be lovely, but not allowed, I'm afraid. So these are the main deductions. If you haven't claimed any deductions for 2021 so far, you can contact the insurance companies, the banks. They can set you up a personal pension and the insurances, things like that. And you can contribute the annual amount before the end of the year. So if you want to take advantage of more deductions for 2021, there is still time to do that. Can I just, before I move on to the next slide, can I just reiterate Becca's comments at the beginning for you to turn off your microphones and your videos, please, because it is being recorded. So if you can please just turn off your video and your mics for any of the new joiners, that would be great. Okay. In terms of deadlines, you have different deadlines for different forms, just to, continue the complexity. For the Form 100, the official deadline is the 31st of March after the end of the tax year. Okay. If you cannot file by 31st of March, which is the majority of the population, you will get a reminder in September saying please file within 30 days. And then typically you will get a second reminder late November time saying please file your tax return. It's enough is enough. Okay. In practice, if you file before the end of the year, there are no penalties. If you file after this date, you will have an €800 penalty per return. Sometimes it's split 400 for each spouse, but per return there is a penalty. So it's really important to file by the end of December. That's the key date. If you're filing the simplified return, 31st of December is absolutely fixed. They will not accept a late filing. So if you file the 163 late, you will not get a refund. Okay. Once you've filed your tax return, the next stage is the tax office will issue a tax assessment. And it's at this point where you will have to pay any tax that might be due. Okay, or you will get your refund. We see a huge variation in practice of timing to receive tax assessments. I'd say 6 to 18 months is pretty common at the moment. We have had them back in 3 weeks. They have 5 years to issue. It can take that long. So it's a bit of a black hole sometimes, and you just have to wait. It comes eventually. Okay. So that was just to summarize sort of the key points and the key thinking that you have to do for when filing your tax return, and also the things you do to optimize. I'm now going to just spend a few minutes covering what actually changed in 2021 and what we're looking at for 2022 in terms of future changes. So from a personal tax perspective, 2021 was really quiet. There was a couple of things that were introduced from last year, and you can look at the slides on the BCC and AMCHAM website from last year if you want to read more on that, which was the employee profit participation regime, and there were some changes to the expat tax regime. In 2021, there were various circulars issued by the tax office, which covered obviously special provisions for COVID-19 teleworking. And those are primarily extended to the end of the year, but we'll cover those more in a little bit. The one most interesting circular in terms of personal tax is there is a circular issued regarding expenses that can be deducted from salary workers. Now, I must admit, when you read it, it is not totally clear exactly what you can deduct. There's some provisions in there for professional training, things like MBAs, work clothing, and there's a whole load of text about home office. It talks about there that it cannot be part of a bigger room. It has to be a separate room. It has to be 90% for business. You can't be able to walk through the room to get to another room. There's a whole load of conditions. But it's quite not the easiest to follow actually, but I mean, if you do have significant expenses as an employee, it's definitely one to look at. One of the big areas we're still seeing come through in 2021 is the tax office sending taxpayers letters saying, hello, we believe that you have foreign income that you haven't declared. Please come forward and declare it for the last X number of years. Quite often 5 years. We have seen a couple at 10 years. So I come back to my very first point. If you're resident, you have to declare your worldwide income. If you don't, it's becoming more and more likely that you will receive a letter and the tax office will ask more information. In terms of things that looking forward that might change for 2022, the most recent budget has put provisions to implement an EU law that says if you make personal pension contributions within the EU, you should get the similar treatment as in your country. So currently that 3,200 pension deduction you can only get for a Luxembourg pension. That should now be extended to EU pensions, and the same, you should get a similar treatment on distributions. Electronic tax cards. This is a big one, especially for employers actually. So a bit less on personal tax, but employers. Electronic tax cards are mandatory from January the 1st. Employers have to register, you have to receive a token, you have to log in to your token and assign it on My Guichet. And then you will receive electronically the tax cards for your employees. There is no longer a tax card for 1 year, they are multiple years, so it's only if the tax card changes, there will be a new tax card. It is mandatory for employers to register. So if any employers who haven't done so, you need to start requesting your token because there's not long until January when the provisions come in place. One of the other interesting things that was sort of mentioned in the budget was plans to increase taxes on unoccupied properties or land that hasn't been built on. So that's something that we expect to see coming in, more details in the future. The other thing that we have seen a lot in 2021, and I think we'll actually keep, it's going to be a topic that's going to continue into 2022, is the implications of COVID-19. Now, there's been special provisions implemented in early 2020 that were kind of EU and wide. From a Luxembourg perspective, there have been agreements with the 3 border countries. They are currently all extended until the end of December 2021, which means that if you are a border worker, you can work from home and your income will be taxed in Luxembourg, not in your country of residence. Okay, so for the border workers through to the end of the year, tax and social security remains in Luxembourg. The harder part is if you are not a border worker, say you are a resident in the UK or Spain and you would normally fly to Luxembourg, during the week and go home at weekends. There's no special agreements. So they have a much harder tax situation, which is what we're going to come on to next. The COVID-19 sort of state aid claims for businesses, we're seeing those coming to an end. They're sort of all phasing out towards the end of the year. But, in practice, I think as we go forwards, the implications of the COVID-19 will continue. Some employers may say, we've got no problem with you working 20% of your time from home. But if the employee turns around and says, no, that gives me a tax issue, I want to come to the office, how does that work if the employer isn't having sort of the office back up to full capacity? Or what if the employer says, I want to work 30% from home, and the employer says, no, that would give us a social security issue because it can only be 25%. Is there potential for sort of discrimination of treatment between resident, non-resident workers? I guess if, a resident worker can work from home because there's not a tax or social security issue, but a non-resident can't. So I think the impacts of COVID-19 and the general sort of change in view of what is acceptable working from home, remote working, teleworking, having to be in the office. It's going to be interesting how it develops over time. With this regard, a couple of points I think they're on one of the earlier slides is in terms of the border countries. If you ignore the special provisions through to the end of this year, if you are a German resident, you can work 19 days outside of Luxembourg without having triggering a tax issue in Germany. If you're a resident of France, from last year they increased the days to 29, so you can work 29 days outside of Luxembourg. There are some discussions that it will increase further, but at the moment it's 29 before you have a tax issue in France. And for Belgium, the recent agreement is for 34 days. It still needs to be confirmed, but you should be able to work outside of Luxembourg for 34 days if you're a Belgian resident without having a tax issue. So, but more than that, you will have problems, okay? Or you will incur tax in your resident country. So, coming on to the bigger topic for today. Now, this is actually quite technical, so I am going to simplify and generalize for the purpose of this presentation. But the non-resident payroll situation has had such a significant impact for some of our clients and some taxpayers this year that I almost had no choice but to put it in here to raise the issue and awareness of this particular problem. So before I go into the detail, I want to just paint a picture, okay? Let's say you've got a taxpayer who is, excuse me, resident in the Netherlands, okay? So he lives in the Netherlands and he would normally commute to Luxembourg Monday to Thursday for work from home on a Friday and spend the weekend with their family, okay? Because they are a Dutch resident, that country has a right to tax their income, 100%, okay? However, because they have a Luxembourg employer and they come to Luxembourg to work, Luxembourg says, well, we would like to charge some tax too. So Luxembourg wants to charge the tax, the Netherlands wants to charge the tax. So in these situations, what you do is you refer to the tax treaty that exists between the two countries. The tax treaty sits kind of like an umbrella over domestic law, okay? And it overrides the local provisions when you have a double taxation situation to avoid double tax. So in this kind of scenario, you've got the Netherlands wanting to tax it, Luxembourg wanting to tax it. The final position will very simply, sort of simplistically be that Luxembourg will get to tax the income that comes from Luxembourg working days. So in our example, where this guy from the Netherlands comes here 4 days a week, 80% of his income will be taxed in Luxembourg. The Netherlands get the right to tax the rest. Now, because Luxembourg have a lot of cross-border workers, a lot of non-resident workers, they introduce some requirements for the Luxembourg payroll to exempt the income that is not taxed in Luxembourg, right? Which is great news in theory, okay? However, in practice, we are seeing some real problems with how this is implemented and how it's dealt with in practice, okay? So that's the picture. We go into a little bit more detail. As I said, Luxembourg has to apply the exemption for non-working days. And this is calculated based on certain guidance issued by Luxembourg. When the individual comes to do their tax returns, they will obviously look to the tax treaty and they will apply the rules of the tax treaty to work out how much income is taxed in Luxembourg and how much is in the Netherlands in our example. The issue we have is the payroll calculation and the tax return calculation are not the same, okay? If I give you an example, and this is a real life case I looked at yesterday, I had a person who spent 100 work days outside of Luxembourg and 128 work days in Luxembourg, okay? So for the purposes of my calculation of income taxed in the other country, I take 100 days out of a total of 228, and this is how I work out how much would be taxed in the other country. The payroll for, however, have used as a base for their calculation 262 days, not 228. And therefore the payroll calculation and the tax calculation are just not aligned. Now, that's not a problem if, when you file your tax return, you can correct it and you can recalculate not on 262, but on 228. The bigger problem we are having at the moment is the Luxembourg Tax Office are taking the position that payroll is definitive. They are refusing to recalculate for the actual working days of these people. And they are saying that the payroll figure, that's it, that's all we'll take. Now, the reason this is such a huge issue is the foreign country isn't going to accept the Luxembourg payroll calculation because it's not based on the actual facts. So they will calculate it based on the facts and the specifics of the situation. And therefore, you end up with a double taxation. In the most extreme cases that we've seen in 2020, we had somebody who worked remotely for most of the year due to COVID. And for whatever reason, there was no payroll exemption at all. So Luxembourg have turned around and said, we want to tax everything because payroll says so. And the other country is taxing the income because that's where the person is a resident and where they were working. So in one of the extreme cases, we've got a guy just now who is double taxed to the tune of €80,000. And because Luxembourg are refusing to recalculate, it's a real double taxation. And that it's these situations why I really wanted to raise this, because it's an issue and it's big for the people who are affected. So just to kind of cover, the people who are affected by this are in three categories in my mind. You've got your border workers, so the people who are resident in France, Belgium, and Germany, okay? For 2021, you're fine because you've got the special COVID agreements. But going forwards, if those agreements aren't extended, then if you exceed the limits for non-Luxembourg working that are in the tax treaties, you will potentially have this payroll real life tax discrepancy to deal with. For any Luxembourg workers who are resident in other countries, and we personally in our client base have a lot resident in the Netherlands and in the UK, if they work outside of Luxembourg at all, they are in this situation. Yeah, they should have an exemption in payroll and it's not matching with the tax return. And then you've got special cases. There's always special cases. At the moment, it's everyone who's been in the wrong place for COVID-19, creating tax issues everywhere, Iceland, Ireland, goodness knows where. And these tax issues knock on because if you didn't know them at the time, they're not in the payroll, and now you have to correct it. And Luxembourg tax office are taking the position we won't correct because payroll has to show it. This is the issue. So if you are a non-resident, you are in one of these situations, what do you do? So as you can probably sort of gather from what I'm saying, it's quite frustrating for a lot of taxpayers. What you should do, in our view, you should speak to your employer. Make sure that you are tagged as a non-resident, they are tracking the days that you're not working in Luxembourg, and they are applying a payroll exemption. Speak to the payroll to understand how they are calculating it, to make sure that you understand what is exempt and what is taxed, and then speak to your tax advisor. Ask them to review your payroll and align it with your actual situation for the year and make sure that the two are aligned. If they're not, then you should be potentially going back to the employer and the payroll and saying, look, this is not my real life tax situation. The payroll isn't aligning. Can you adjust it? Okay. I think that, you know, on a lot of the salary certificates we see as well, the salary certificate has a box on some of them that says, this is the amount to report in your foreign country. And if that's not the right amount, when the foreign country says we recalculate, the employees could come back to the employers and say, well, you gave me wrong information. Yeah. So I think that there's a real kind of wider issue with this scenario. And like I said, we're seeing cases with huge double tax situations, and fighting it is really, really difficult at the moment, which is why it was my technical topic for this year. Moving on, last bit, and then you can, Jonathan will let me know if there's any questions that people want me to answer. So UK and US, just little things. In the UK, obviously Brexit came in at the start of 2021 officially. The tax treaty didn't change, so normal tax treaty provisions applied. There was a social security agreement with the EU. It is roughly the same as the general EU one. The biggest difference is to do with who's entitled to child benefit. So that's one of the differences, but fundamentally in the main, it's quite similar. The UK HMRC continues to focus on, if you are a UK resident, have you disclosed foreign income? Is your foreign tax credit claim correct? They're sending people gentle reminders that you've claimed a foreign tax credit, and are you sure it's correct? And would you like to change before we go and look at it? That kind of thing. The one thing that will affect a lot of our clients who are not UK residents but still have real estate, when you sell your real estate, up until now, you were required to do a tax return for the specific sale of the real estate within 30 days. In the last couple of weeks, that's been extended to 60 days. So people have a little bit more time to make those filings. From a US perspective, the fun and games this year and going through to 2021 taxes is stimulus payments and advanced child tax credits. We've had so many people who have received US checks in the post. They can't cash checks here in the banks. So there's loads of people going around with these, little pieces of paper that they can't check, they can't cash, don't know how to cash, and tracking them. There's so many small little payments coming through. Tracking them to put on the tax returns can be quite a challenge. The last piece I wanted to raise on the US side was pension. Only because we've seen a lot more cases this year with people incurring penalties when they've made contributions to IRAs that they couldn't actually make. So it's really important, if you are American contributing to an IRA, for a Roth IRA, your income has to be below certain thresholds to be able to contribute, otherwise you will get a penalty. And if you are excluding all of your income under the foreign earned income exclusion, you cannot contribute to any IRA, not a traditional and not a Roth. Okay, so that's one that catches a lot of people, and they incur penalties year on year as a result. Okay, that's it from me for this year. I hope it has been interesting, and yes, I guess over to Jonathan if there are any questions.
Thanks a lot, Laura. Thanks a lot. No, very, very clear. Very clear. I must say, super slide deck. Well done. Very, very clear to everyone. So to everyone, I think they were, I've seldom seen so many questions in the chat box. It's great. So way more, we'd need at least an hour to go through all these questions, Laura.
Okay.
So
I don't know how I can see the chat, but anyway, yeah.
So,
go.
no, it's fine. I'll gladly monitor this. So I think there were a few questions already, just so for everyone on the Zoom call. So the slides will be shortly available for download on the website of the British Chamber and AmCham. So this will be publicly available shortly, I suppose, in the next few days. Many questions here, Laura. Let me start from the beginning. So question from Anya: what tax class are we when we become a new widower?
So yes, there are certain, I didn't cover every eventuality. When you are recently widowed or post-divorce as well, you get to keep the previous tax class for about 3 years. So normally if you're recently widowed, you would get class 2. And then I have to remember, I think you get class 1A for a longer period after that. Very
super. Thanks a lot, Laura. Thanks a lot. There are some questions here which are more like case studies, but let me try and scroll through here for you, Laura. So
I guess anybody can feel free to ask their questions directly. The contact details
well.
are on there, so.
Yep, exactly. So exactly. So there, yeah. So Laura's contact details are exactly on the slide here. That's very clear. How are directors' fees taxed?
To a resident or a non-resident?
I would assume to a resident.
Okay, so directors' fees, they receive a withholding tax at source, and then they are included in your tax declaration under the independent income category, tantièmes. Non-resident directors, just in case it was for that, sometimes the withholding tax can be a final taxation. It depends on the level of the director's fee.
Very clear. I think we've got a similar question here on rental income from property. So I mean, again, I'm assuming the property is situated in Luxembourg.
Okay.
So I mean, so let's just say you receive a rental income on a home you rent out, you let. I suppose, I mean, this simply comes into the rental income category.
Yeah,
right?
rental income category. So you would take the gross rental income, you claim expenses specific to it. So typically repairs, maintenance, if there's management fees, insurances. You can also depreciate the property. That depends on the purchase price and the age of the property. There was new depreciation rules came in at the start of 2021. And for more details on that, refer to the slide deck from last year, because I covered that in detail last year. But yes, the rental income is taxed. The net rental income is just included as part of the tax return.
Very clear.
If you have foreign rental, okay, same calculations as for a Luxembourg rental property. However, the foreign rental is normally taxed in the country where the property is situated. So it is not taxed again here. However, if you make a net rental profit from a foreign rental, it will increase your tax rate in Luxembourg, so you will owe. And if you have a net rental loss from a foreign property, your tax rate goes down. So it does impact the actual Luxembourg tax that you pay, but you are not double taxed on rental, because foreign rent, because Luxembourg doesn't tax it.
Right. No, very clear. Very clear. Thanks, Laura. And that kind of makes sense. There's one question here on pensions. I believe this goes back to your slide with the different rates and different amounts. Because question from Joanna here on personal pension deductions, which is now I think 3,200 euros. Wasn't this lower in the past, or maybe this is
Yes. So go back. So pre-17, if I remember, it used to be 1,500 and then 1,750, and it would go up. It would increase with age. It's been 3,200 for everyone since the 17 tax reform, I believe, if I remember rightly.
Sorry, Laura, I had to open the door. So yes, we have quite a few more questions. I think I'll take another 2 questions, and then I'll post up possibly to Paul. There's so many questions here, Laura.
Can you download them for after, or?
Yeah, I'll discuss that with Becca afterwards, if we can somehow
we are
download or save the questions.
We are saving the questions, actually, Jonathan, so we would be able to pass them on to you, Laura.
Okay.
Cryptocurrency. I think you mentioned this, Laura, in your presentation. Again, I mean, assuming, of course, that's you trade on cryptocurrency in your private capacity. It's not your job, right? I mean, how would that mean the taxable event? I believe the taxable event is upon any gain you realize on the sale of a crypto. So it's a capital gain.
It's a capital gain. In a lot of cryptocurrency is it's like quite fashionable just now. You're no one if you haven't got a bit of crypto. So some of the real basic stuff for cryptocurrency: if you are buying and selling, then you will incur a capital gain. I give an example. If you bought an Amazon share and then you sold it to buy an eBay share, you would expect to pay tax on the gain or sale of the Amazon share. Similar with crypto, if you buy a Bitcoin and then you sell it to buy Ethereum, you have to work out what happened with the Bitcoin. So even intra-crypto trading can result in gain. Now in Luxembourg, if you hold it for at least 6 months, there is no taxable gain. But for people who are trading multiple trades, I mean, we have some people who send like 2,000 lines of trading. I mean, how you match it is really difficult in practice. And, you know, you have to use some of the software. I think Coinly, you can feed stuff in and it spits it out. But it's really difficult to match, actually.
Right.
And Luxembourg says that if you can't match, you should use an averaging method, which is like to calculate. My
Okay.
so would say.
I'll take one more question, Laura, for you. And this goes back to the electronic tax cards you were also mentioning in your presentation.
Mm-hmm.
Let's just say you employ and you declare, of course, a part-time cleaning lady. So technically you're an employer, right? Do you also have to issue a tax card to your?
No. The people who you've got as the home cleaners, the domestic workers, they have a whole special tax regime. So they're not in this. They have a special tax regime that would continue. This is more like, you know, for me and my employees, we have to get electronic tax cards. It's the other thing to note on that actually is as an individual as well. Since the start of this year, you can sign up on your own private MyGuichet, and you can get your tax card and your tax assessments electronically through MyGuichet. That's new as well.
Very clear. So the questions we have not had the time to address, do feel free. I mean, we will keep these questions, and do feel free to reach out to Laura. The contact details have been on the screen for quite a few minutes now. Paul should, I believe, be in the meeting. Paul, I'll be very delighted if you could perhaps share a few words of thanks. I'll leave the floor to you to maybe close this year's event, as we all hope to meet this time next year for the 2022 personal tax event, hopefully in a real lunch event.
Yeah, I have to admit that I'm looking forward to lunch next year too. But as every year, I think I speak for all of us to most sincerely thanking Laura for an outstanding presentation. And for any of you, we can't more strongly recommend Laura to you as being a high quality person who's honest, trustworthy, and does an absolutely outstanding job. From an AmCham perspective, we're delighted for us to be doing this every year as a joint event with the British Chamber. Our offices are next to each other. We more or less speak the same language, and we're happy to be partners together. So those are the 2 points that I wanted to make, and I only have one more, and that's to wish everybody, well, actually 2 things. One is use what Laura said, and if there are still some things that you can do now, you still have time to do for this year to make sure that you optimize your tax situation. Please do that and do it now. And then the very last thing is to wish you all a very Merry Christmas, a very Happy New Year, and a good and successful New Year in the year to come. Thank you all very much for joining us today. I think this is the biggest crowd we've ever had, and we're delighted for it. And if you liked it and enjoyed it, tell your friends to join us next year. Okay, that's it. Thanks.